Hi, I am Sai Prabhakar, Principal Research Analyst at the Hindu Businessline. Today, we are revisiting Caplin Point, a stock we have been positive on in the past. Our accumulate calls in July 2022 and April 2024 proved successful with the stock more than tripling, delivering over 230% returns from the first call. This impressive growth was fueled by a 26% revenue CAGR over the last decade and an industry-leading margins of 34% EBITDA and 27% PAT in the recently concluded FY24. However, we are moderating our outlook to a hold rating. While we expect continued growth, some key headwinds are emerging. Caplin Point's success has been built on a unique model in the smaller Latin American markets. They have established a strong last mile presence, controlling warehousing, distribution to pharmacists, doctors or stockists, and sourcing about half their revenues outsourced from India or China. This has allowed the company a sticky presence in the end markets, a cost competency, and a strong supply chain control and cash flows. This is the base model of the company. Now, Caplin Point is expanding into larger, more competitive LATAM markets like Mexico, Brazil, and Chile. These markets are larger, more competitive, and involve elongated approval cycles. Compared to the other LATAM countries, Mexico and Brazil have presence of almost all generic operators including Sun Pharma, Torrent Pharma, Lupin, and others. As Caplin replicates its business model, which emphasizes on distribution strengths, the long-term growth may be secure, but it will be a slow burn. On the other hand, their US business is booming, growing from 130 crore in FY22 to 317 crore in FY24, driven by their sterile product portfolio, which includes ophthalmics, injectables, pre-mixes, and ready-to-use bags. Caplin's sterile capex and line extensions have paid off, and the last leg of the capex is underway. Caplin Point is also exploring complex molecules through partnerships in China, which aims to leverage their existing distribution network in LATAM and eventually the US. Also, the company is transitioning its oral solid dosages to sterile formulations where applicable. This will involve preliminary studies and several approval iterations, which is either for LATAM markets where it intends to start with or for the US markets. These three strategies, LATAM expansion, US steriles, and China partnerships, represents the next phase of growth. However, increased complexity, longer approval cycles, and potential supply chain disruptions will likely impact the pace of this growth. Remember, excluding US, their growth has been around 10% in the last 2 fiscal years at the top line. The stock's valuation has nearly doubled, now trading at 32 times forward earnings compared to 16 to 18 times previously. This high valuation coupled with more complex growth path is a key consideration. Finally, the reliance on sourcing from China presents both opportunities and risks. It could be a strategic advantage or it could lead to increased scrutiny. This uncertainty adds another layer of complexity. In summary, while Caplin Point has a strong track record, the increased complexity of its growth strategies and its higher valuation leads us to change our rating to hold. Thanks for watching.